Welcome back to Palisade Radio. I'm your host, Tom Bodrovics, and joining me today is returning guest Lawrence Lepard. How are you today, Larry?
I'm great, thanks. Nice to be on your show, Tom.
Great to have you back. Lawrence is a gold stocks fund manager from Boston, and his gold fund was up 122.9% in Q2. That's some awesome performance, as we've seen from most gold stocks and funds in Q2. Larry, I was thinking we could start by talking a little bit about what we've seen since April. And that was the last time we spoke. At that point, we hadn't really seen the monetary printing that we have since then and the ramifications of it. So let's talk a little bit about how much federal debt, how much it's expanded by, and maybe some of the deficits that we're seeing. Sure.
It's a big topic. And first, I should say that 122, recall that I was down 38% in Q1, so it's not quite as good year to date as that would imply. This is a volatile space. So the national debt has really taken off since the COVID crisis occurred. We were kind of in the 23, 24-ish area, and we're now well up over 26.5. So in that several months' time, it's growing quite quickly. The rescue package, the CARES rescue package put together with COVID was $6.2 trillion in size. Some of that was expenditure, some of it was loans. The underlying budget deficit for the quarter, and this is rather stunning, was $2 trillion. So if you annualize that, that's 8. Now, obviously, a lot of that was one-time kind of stuff. The PPP and, the checks that were sent to people and so forth may or may not be repeated. So you can't realistically take the $2 trillion and annualize and say we're running an $8 trillion deficit. But I've looked through it on a monthly basis and dissected the numbers pretty carefully. And it is clear to me that we are running a $4 trillion deficit, unless we do more stimulus. And so last year we were running about a $1 trillion deficit. It was slightly bigger than that because they understate the numbers since the balance sheet. We grew at 1.2 last year, but round numbers, we had a $1 trillion deficit last year. My estimation is that we're running about a $4 trillion deficit this year, base rate before any extras. And of course, they are talking about more stimulus packages, and it's possible the economy won't grow or will deteriorate on a going forward basis. So, I think 4 is a low number. I think it's very easy that we could have a $5, $6, $7 trillion deficit run rate in a very short period of time. And of course, that all gets added onto the debt. So with a $20 trillion GDP, debt at 26.5, and, they were originally saying we'd be at 30 trillion of debt in, 5 years from now, 6 years from now. I mean, it looks like we're going to be at 30 trillion in debt probably by the end of this year, perhaps a tad longer than that. And the point is that means we're at 150% debt to GDP, which is a very big number, and historically has led to currency debasement in other countries that have tried this. There are some exceptions, but the Treasury issuance this year, and this is in my report, we should mention that you can get my report by going on Twitter and following me. I put links to it there or links to sign up to my newsletter so that you can get the report naturally. In the past, I've offered the right to people to say, hey, send me an email and I'll send you the report. The problem is I got 2,000 emails and I'm backlogged on filling those out. So the best way to follow me and get these reports is to go to Twitter. But anyway. Just before we continue, that's at Lawrence Lepard,
LAWRENCE LEPARD. Yeah.
So, in the Guggenheim organization forecast that we're going to issue close to $5 trillion of new treasuries this year. And, in the past, as Luke Roman and others have pointed out, we had foreign buyers for these things. And so we didn't have to print the money. We could issue the debt and somebody else would carry it. And so there wasn't a natural monetary inflation. Now it's become very clear, because you can see it in the Fed balance sheet and you can see it in the Fed Treasury purchases, that when we issue treasuries, there's really only one buyer left, and that's the Fed. And so the Fed is monetizing the deficit and printing money. And if one looks at history over the last several hundred years and studies countries that have run into currency trouble, one sees that that currency trouble has almost always been preceded by a run-up in debt and then a conversion of that debt to money printed to cover the debt. And that's exactly what we're doing. And so this is very unfamiliar to a lot of people because it doesn't happen very often. And it certainly hasn't happened in the United States since, the Continental, when we were founded as a country, or to a smaller degree, Civil War, when they issued greenbacks. But in general, we've had a pretty stable currency environment, although one could argue it hasn't been as stable as many say since post-71. We've really been truly fiat, and the dollar has lost a lot of value. But on a relative basis, the dollar was the cleanest dirty shirt. But I would argue that maybe that's not even going to be true on a going forward basis because of the stimulus. And the government has really kind of got themselves into a pickle. They can, in theory, they could stop spending. In theory, they could cut back spending. In theory, they could raise interest rates and they could try and make the dollar strong again. But, the natural outcome of doing all of those things would be just to put the economy right into the dirt. And we'd have a depression on our hands. And, we might arguably have a depression even if they don't do those things. But setting it aside, this economy cannot handle higher interest rates and reduce spending. I mean, if those things occur, this economy is going to crater. And so what we know is that the policymakers who run our government, they view their job as keep things going, keep as many people employed as possible, and keep the economy from cratering. And if to do so they have to print money, well, then they'll just view that trade-off as something that, they have to make, and they'll worry about the inflation later. And they've been blessed because, as a result of the China price and low money velocity and a lot of other reasons, inflation has been relatively low. And there's a psychology that says inflation is always going to be low. And I think that's been a reasonable thing to assume based on looking backwards. But like so many things in life, everything comes to an end. And so I think this low inflation environment is coming to an end, and there's signals everywhere that it's happening. And as it comes to an end, it's going to be a very, very bad thing for people who are in fixed income securities. And it's going to be a very good thing for people who own forms of money and assets which cannot be readily printed or replicated. So, and gold obviously is the top of the list in that category.
So how is this money being distributed, Larry? Obviously, we've heard that this stimulus package was more for Main Street rather than Wall Street. So tell us a little bit about how it has been distributed and maybe a little bit about how the bank reserve rules have changed.
Yeah, okay, great questions. I mean, first of all, they really did cross a Rubicon when they started sending money to people and companies. I mean, in 2008, a lot of people say, well, this looks like 2008, and we came out of 2008 okay, although it took a few years to recover, and this will be the same. And I say, well, yes and no. There's similarities. They're plugging the holes in the bank balance sheets, but they also went direct, and that's a term that the Federal Reserve has said, in the next downturn, we don't have the policy tool of dropping interest rates from 5% to 1% the way we did in 2008. Rates were at 2 or 3%. We took them to zero. But so there's not as much effect there. We've got to do something different. We've got to go direct. And so, the $1,200 or the $2,500 per family, that's a form of going direct. The PPP loans to businesses, some of which were very healthy and didn't need the loans, but they got them anyway. That's a form of going direct. And that's really just printing money and giving it away to people. And, one could argue that it's important and necessary and humane to do it. And one could also argue that the amount given to the people is really trivial compared to the amount given to companies, and there's still a lot of crony capitalism going on. But the point is they crossed that Rubicon, and this is the kind of thing that was, Bernie Sanders, universal basic income sort of stuff that never would have been thought about pre-COVID, and now it's just become accepted. And, my sense is that, the Republicans are putting on a show of trying to be frugal about not extending it. My sense is they're going to have to extend it because the economy is going to crater if they don't. The other thing they did is they extended the unemployment benefits and they cut the payroll tax. So there were a lot of ways in which they printed money and put it into the system. And that's why if you go to my report and look at page 5, what you see is that the change in the money supply in this particular circumstances is much higher than it was in 2008. And so that to me there's your fuel for your inflation that's coming. The other thing they did, I think you brought up, it's an interesting point, and a lot of people missed this, but again, Luke Roman saw it and pointed it out, is they dropped the bank reserve requirements down to zero. The way that money gets created in a couple of ways. One thing is it gets printed and spent by the feds. Another way it gets created is that the banks effectively issue credit. And so you have a multiplier effect when money gets injected into the banks. They loan it out, it gets deposited and loaned again and again and again. But there's usually a limit to how much that can happen because the bank has to keep some money in reserve as a reserve requirement. Well, because they knew that this was a really bad one and they had to get a lot of money into the banks, and they wanted the banks to be in a position where they were able to buy a lot of treasury bills which needed to be financed, they basically said to the banks, your reserve requirements are now zero. You can create an unlimited amount of credit, which really is, to me, quite stunning. I mean, it just, and it actually fits, too, with the Federal Reserve rhetoric. These people have been saying things. I mean, Jay Powell basically said, look, we are going to do whatever it takes. We are going to print money. There are no limits to what we can do. I mean, some of the quotes out of the Federal Reserve have just blown my mind, in terms of their aggressiveness. And I think that's because, the fear of God got put into them by this collapse. And they realized that if they didn't say those kinds of things, they were going to have a smoking wreck of an economy on their hands. And some people have asked them and said, well, look, you're doing all these things. Doesn't that mean there's a potential risk of inflation? And they've even conceded, yes, there's that risk, but we will deal with that later. We're going to do one thing at a time, and our first job is to make sure the economy doesn't implode. And then our second job will be to solve the inflation problem. And, they probably realistically think that they can solve them in some kind of sequence and that they'll have tools to go after the inflation problem. But what I would submit is that they won't, that once the inflation's out of the bag and Gresham's law starts to kick in, they're going to have a real problem. And they're not easily going to be able to solve the inflation problem. So, another argument for why gold is a good place to be.
So obviously you touched on a couple times about inflation and, let's say, a natural consequence of this much printing. So what could some of the consequences actually be? And explain to us a little bit about a term you're trying to coin, CSIP.
Yeah, and I'll be famous if this term catches on. So I thought, well, why not give it a try? So everyone talks about inflation, and the traditional inflation is what you learn in Macro 101, right? It's demand pull or cost push. The labor market's too tight, people start raising wages, they have to pass it along in prices, blah, blah, blah. Okay, that is one kind of inflation, and that's what gets measured in the CPI. And that's really what the TIPS price off of, and everybody uses that as your inflationary measure. I mean, the Fed uses the CPE, which is it's their own version of the CPI. And that's an important measure of inflation. It shows how goods are going up, and in a normal economy, you can kind of get a sense of what prices are changing. And a couple things have happened. One, they've really messed with the CPI measures. They've used hedonics, they've used substitution, they've used all kinds of things. And basically, the CPI now is, in my view, a joke. It's a cooked number, which, if you compare it to the Chapwood Index or the STS numbers, Shadow Government Stats numbers, it's nothing like the real inflation that we experience. I mean, everyone knows we've seen inflation in healthcare, we've seen inflation in higher education, we've seen inflation in lots of places. It just hasn't showed up in what they call the CPI. I think it will. But even if it didn't, here's another kind of inflation that and why I've coined this term, currency substitution inflation psychology. I call it CSIP. And what it means is, people have assets, people have savings, not everybody, but most people, even people who don't have a lot of savings, they get paid in some form. They get some currency when they get their paycheck. And then they have to decide what they're going to do with it. Are they going to, unless they're going to spend it instantly, they're either going to leave it in their bank account as a deposit, or they're going to do something else with it. And, and if they have assets and savings and they have a retirement account, they got to decide what are they going to do with it. Are they going to put it in bonds, stocks, or cash? And if they believe that it's going to hold its purchasing power, those three choices, all of them would be reasonable to do. But once they begin to think, hey, you know what? This money is not going to buy me as much in the future as it has in the past. In other words, I believe this money is losing its value. It's a currency, and they start to substitute it based on an inflationary psychology. And they start saying to themselves, all right, I've got this currency, cash, but you know what? I know these prices are going up. I know this cash isn't going to hold its value. I know they're printing like crazy, and I know they can never stop printing. And therefore, I'm going to find some other currency which is better. I'm going to find, I've got the right to buy another currency that won't go down in value. And of course, the natural choice there is gold or silver. I mean, they're both 5,000-year-old currencies that can't be debased. And so the substitution effect becomes very real, where they say, I'm getting out of this currency that's losing its value, and I am getting into a currency that is going to appreciate or hold its relative value. And so sometimes people say, well, the price of gold is going up. I say, no, a gold ounce is a gold ounce, never changes, right? What's really happening is the dollar is going down in gold measured terms. And so as more and more people become aware of that, you're going to see more and more people leaving the dollar and putting their savings into gold. And it's nothing more than Gresham's law, which is the bad money dollar gets spent, and the good money that you want to save, you save your money in gold. And, since 2000, gold has gone up kind of 10, 11% a year in most currencies. And, you'd be hard-pressed to find, a lot of investments that consistently over that time frame have gone up 10 or 11% a year. And so I think, the signal here that we got a real inflation problem is going to be the gold price. As the gold price continues to appreciate, we're now very close to the all-time high from 2011 of 1921. I mean, we closed almost plus or minus within $50 of it today. We had silver up 8% today, which is just stunning. It was up 7% yesterday. I think there's a real chance that people are beginning to move towards the exits rather aggressively. Now, am I sure of that? No, there could be another slam. The prices could get hit back down. There are lots of ways that the people who run the system have where they've been able to mask the underlying debasement that's been taking place. But when eventually gold breaks through that all-time high of 1921 and then through 2000 and then through 2500, what you're going to see, I think, is continued awareness among a bunch of people that, oh my goodness, the cash I have, the money I have is getting seriously debased rather quickly. And when financial survival is at stake, people can be pretty aggressive and they can move pretty quickly. And so, if gold takes out 2,000 and then it rather rapidly takes out 3,000, well, my opinion is it's going to 10,000 and then ultimately it's going no offer because the dollar will be worthless. And I don't think that's as far-fetched a possibility as the average financial advisor would think. So, is it going to happen for sure? It may not. I mean, I sincerely hope for the country's and other people's sake that at some point in this process, the government gets intelligent and says, hey, we got a debt problem here. We're going to have a one-time restructuring. We're going to transition to a gold standard, and we're going to do 5 old dollars equals 1 new dollar, and the 1 new dollar is going to have a gold backing, and the price is going to be X. I mean, that would be the way to nip this thing in the bud and prevent a full-fledged collapse of the currency, which I actually think is a possibility. But, it would be sad if it happens. I don't want it to happen, but I'm paid to be an analyst, and that's what I've done for, 30 years of my career. And so, as I analyze it, that's what appears to me is going to happen. So obviously, I think that, not having some of your savings in the form of gold or silver is not wise. I think it's very wise to have something here. I think everybody has to decide what weight they want to put on it. But I think a lot of people are missing the fact that as good as this stuff has been for the last 6 months, this could be just jacks for openers, as Bill Murphy likes to say. I mean, it's possible that we're going to go into a situation very much like the 70s. I know in our earlier conversation, you asked me about that, and I was around in the 70s. I was young, but I was investing. There was talk in the late 70s that the dollar was going to completely fail. And, when gold hit 700, 800, that was kind of what the talk was, and that inflation could never be tamed. And, it was kind of the end of the road for the dollar. Paul Volcker came in, put rates up to 20%. Can you imagine that today? I mean, if we had 20% interest rates today, the entire world would go bankrupt, right? Mm-hmm. Put rates up to 20%, created an enormous real interest rate, and put a halt to it. But I don't think they have that solution today. I don't think that's one of the choices they can make. So I think the better solution would be to try and do a restructuring, and I hope that's what they choose to do. I mean, there are a lot of interesting things going on, right? It's very interesting to me that they just put Judy Shelton on the Fed board, or at least they recommended to the Senate. The Senate may not vote to put her on. And she's a very strong sound money advocate. She's weakened her views a little bit recently, but I think that was just for the cosmetics of having a chance to get in the ring, and at least I hope that's the case. I think more and more people are coming to realize that we've got a serious issue here. I mean, the numbers are just so large this time around. There was a story on Zero Hedge today that a guy, Deutsche Bank's top credit analyst, makes stunning admission. I am a gold bug. Fiat money is a passing fad in the history of money. I mean, these are establishment people who are coming out and starting to realize that gold has a role to play in a monetary system that's kind of lost its bearings with respect to what's really valued. So it's certainly interesting times, I'll say that. And I worry continually that, we'll have setbacks here, but yet, and that's why, nobody should take all of their assets and put them into this category. Although ironically, that's kind of where I am, but I can afford to do it. But I think everybody should have some of their assets in this category, because it's very, very clear to me that we're in that circumstance that happens once every 100 years or so, which is, you have a sovereign debt crisis. And when that happens, a new monetary regime comes in, and there's the ultimate form of money is gold and silver right next to it. So.
Larry, as you were talking about Paul Volcker, you have a piece in your quarterly letter about him saying in his autobiography that they made a mistake by letting the price of gold get away from them in the way that it did. So what do you think the possibilities of the Fed taking actions against gold could be? And without really touching on, or let's highlight some of the considerations that one should have, not mentioning confiscation.
Well, confiscation is always a risk, and it's a reason to have some diversity of where you have your holdings. We get into a lot of philosophical and political discussions here. There'd be a lot of boating accidents. I think if people said, if they went to confiscate, I think there are a lot of heavily armed people who might say, well, I lost mine in a boating accident. Let's go to the Volcker question first. What tools do they have? I suppose they could threaten to confiscate, they could threaten to heavily tax, and they could try to discourage. Let me say this, because I also said this in my letter. I think for a while, they're on our side. Okay. In other words, I think the people who run the show, at the Fed level are smart enough to know that they absolutely have to have inflation or the whole thing's going to crater. So my sense is very much like in 09 and 010, they've got much bigger fish to fry than the gold price right now. I mean, they probably want a higher gold price. They want to have some inflation. They want to see the economy keep going. They want to see the stock market keep going up. And in other words, in fact, I think the S&P is a national policy tool. I think the S&P, I've come to see it the way Luke Roman sees it, which is we can't have the S&P decline or else the economy is going to go tapioca. And so my belief is that they want to see a higher price for a while. Now, what they don't want to see is a runaway price. They don't want to see Gresham's law kicking in spades, which is frankly why watching what's going on right now gives me a little bit of concern, because I would prefer that we just got a nice orderly growth in the price, year on year. Alistair McLeod, who does a great job on Twitter talking about this, he thinks this whole thing will be over in 6 months. He thinks, we've got kind of a John Law-like environment, and in 6 months the whole thing will be over and the dollar will be worthless. I think that's possible. I don't think it's likely, but I think it's possible. I think there's a chance they'll threaten at confiscation. I think there's a chance they'll threaten at a Bitcoin-like solution or a Fed coin-like solution. I think there's a chance that they'll maybe talk about a restructuring or some kind of a debt jubilee. And all of these things could be rather turbulent for the gold price. But in general, I don't think they can kill it. Even if they confiscate it, they'd have to pay you, the going price for it. And I think it's a small enough percentage of total assets out there that they're not likely to go for it, because confiscating what people don't have doesn't really solve the problem. So, I'm not sure, to be honest with you, what all the tools are. They can't do Operation Twist. Operation Twist was how they got us in 2011. I mean, we had them on the run in 2011. I mean, gas in Massachusetts was $4. Silver was $50. Gold was $1,900. They realized that all the money they created in 2008 was a problem. And so, they had a big meeting in D.C. Goldman Sachs came out with a big negative report on gold. They got all their friends heavily shorted, and then they went out and they just hammered it. I mean, and I watched it because I was in it, and they were trading such enormous blocks in 2011 that there's no way, there's no investment firm big enough to trade those kind of futures blocks. The only people who could have been doing that were the central banks. It was the only people. And they did it to correspond with Operation Twist, which is when they basically went from the long bond was at like 4.5, and that's the biggest indicator of future inflation. And so they knew they had to kill it. And so they did Twist, which was diabolical. I mean, they basically sold treasuries and used them to buy long treasuries, and they brought the long bond yield from 4 and change down into the low 2s, as I recall. So that was a diabolical move, and that put the kibosh on the gold price at the time. And then it allowed them to create another credit cycle. And of course, when a credit cycle is going up, nobody needs gold, and so everyone switched over and started buying the FANGs in 2011, 12, and 13, and they got this everything bubble going. So can they do all those things again? I don't know, maybe, but we're at kind of the ultimate level. I mean, first it was .coms. They reblew that one with housing. Then it was housing, and now they reblew that one with the sovereign credit level. I mean, what's the next level up? I mean, we're going to save by Jupiter and Mars. I mean, I don't know. I mean, I don't think there's a next level, another bubble to be blown. But can they make it messy in the interim? Oh yeah, I'm sure they can. But I'm hanging on to my coins, and I'm hanging on to my gold stocks. And if they go to grab the coins, the stocks will do very well. I mean, one thing to consider, in the 30s, they grabbed the coins, but the stocks were a 10-bagger in the 30s, and that was the big stocks. The little stocks were probably 20 or 30 baggers. They don't really record all those. It's hard to get the data from back in the 30s. But it's valuable stuff, and 6 billion people know that it's valuable stuff. And there are a lot more of us than there are of them. The powers that be, I mean, we all sit here and quake at, what the Fed and the government can do, but it's really a small group of people. And when the currency starts to become worthless, people are going to be pissed off, and rightly so, and they're going to be really pissed off. I like the hand we're holding a lot more than the hand they're holding. I think they're screwed. I mean, I think they're absolutely screwed, but we'll have to see. I mean, it could be a very rocky and rough road. And frankly, that wouldn't surprise me, and I'm kind of used to it. In March, my fund went down. I think at one point my fund was probably down. If you marked it to market, I almost couldn't look. I mean, I was probably down 50 or 60% year to date on March 23rd. I mean, that awful day when JNUG blew up. But I had a little bit of cash. I used it to buy, and everything else I had, I held. I rotated out of some of the bigger names and bought some of the cheaper, smaller names. And we came out of it. It's a very volatile space, but that's what happened. And this is the danger. I mean, what these people are doing is absolutely criminal. When you play with the value of the money, you're really playing with fire, and you can destroy a society this way. Lenin said it. Rothschild said it. Give me control of the money. I don't care about the laws. You really are playing with fire. And I think we're going to end up back on a gold standard. I don't think we're going to end there necessarily because enlightened people in our governments are going to take us there. I think the odds of that are pretty low. But I think we're going to end there because once this currency is worthless, everybody's going to realize nobody's going to ever trust fiat currency again. And we're going to go back to first principles, which are gold and silver or money. They were naturally selected that way as a result of 5,000 years of history. So I think that's where we'll end up. And therefore, having coins, having things related to gold will be, a very wise thing to have done in terms of protecting your wealth. I mean, Egon von Greyerowitz has done a great job of saying this for 20 or 30 years. Others have too. I mean, Peter Schiff, there are a lot of people who totally understand it and have been out there talking about it. And of course, we were all branded as crazy for many, many years, but we're not going to look so crazy here. We're starting to not look crazy now. And in a couple of years, I think we're going to look absolutely brilliant. And we're not as brilliant as we'll look, but we weren't as stupid as we looked in 2015 either. So there's got to be some midpoint in there. And I sincerely hope that it doesn't have to get ugly and nasty. And one thing, everyone says, well, look, this is going to be horrible. How can you be rooting for this? I'm not rooting for it. I'm just observing it, one. And two, I've actually studied enough of these cases that if we don't get into a big shooting war, if we don't kill a bunch of people, once you restore sound money, things actually go back to normal pretty damn quickly. I've read everything there is to read on Weimar. And this guy, Schacht, who came in after the thing collapsed, put him back on a gold standard. They tested him a few times. He held firm. And bang, the whole economy just got going again. Now, they were so pissed off and angry, they elected Hitler. But that's a different problem. The monetary shit can be solved. If we go back to sound money, if this thing collapses and Judy Shelton says, okay, look, we got to have a sound currency here. We're going to follow the Constitution. It's going to be X grains of silver, whatever it might be. We can recover. And by the way, everyone's going to be in the soup. The other countries are going to have the same problems. I mean, all these currencies are going to collapse. But when we go back to sound money, I think we'll be stunned at how quickly, with all the technology we have and the self-organizing society we have, I think we could be stunned at how quickly things get good again. And that's kind of what I care about because I'm worried about my kids and my grandkids. I'm 63. I mean, whatever. I can't complain with the way my life has gone. But I care a lot about how my kids' lives are going to be. And I think the sooner we get to sound money, the sooner we're going to have a foundation on which I think we can build good lives. To the degree that I make money on this thing, I mean, I've already committed. I'm going to spend a lot of that or some piece of that on arguing for a sound money standard. I think it's the biggest thing that we've got wrong in the society right now. It's going to be interesting to watch. I mean, I think Eric Sprott's going to be the richest man in the world by far. I think Buffett and Gates are going to be nothing. They'll be fine, obviously, but I think it's going to be kind of stunning how big the wealth transfer is here that takes place. Because if you take fiat currency down to zero, the people who own gold and silver are going to have a lot of marbles. So
anything that can't be printed, right?
That's my story, and I'm sticking with it.
One of the last things I'd like to touch on, Larry, if you wouldn't mind explaining to us a little bit about kind of how best to play this scenario. You were saying you own coins, but you also own stocks. So maybe tell us a little bit about emerging producers, how to identify them, and why they kind of present a very asymmetric gain opportunity in this.
Sure, be happy to do it. I mean, so first of all, everyone should understand that stocks are risky, okay? I mean, for people who don't know what they're doing and haven't invested in stocks before, you can hear all kinds of, please buy this hot stock tip. And I mean, the Robinhood crowd's going to come in here and you're going to see some of these things doing moonshots. Everyone's going to be talking about how easy it is. And nothing could be further from the truth. So, I mean, part one, I mean, anyone who's buying stocks, if they don't have some coins in front of that, they're nuts. You got to start off with some savings, okay? You got to have some coins that are going to hold their value because everyone needs a base of savings. Okay, fine. You got your savings. Now you got some money and you're thinking, all right, I'd like to see this grow. The coins are just going to sit there and they're not going to have sex and multiply. They're just going to sit in your vault and they're going to grow in value on a relative basis, but they don't grow otherwise. Okay, so now you want an asset that will grow in value potentially because it's going to do something constructive. As Buffett says, gold is a goose that doesn't lay eggs. Well, okay, the stocks do lay eggs because they grow their production and so forth. Okay, within the stocks, in my opinion, you can see this in my writings, my opinion is that the sweet spot is what I call the emerging producers. And these are companies that have a mine. I mean, backing up for a second, there are three kinds of stocks. They're drill stories. They're the most exciting. They're going to do moonshots or crater. It's gambling. You can do it. I do some of them, but you got to be careful. The average person shouldn't be doing drill stories. Producers are development stories are people who have a deposit and they're going to try and build a mine. Not quite as risky as a drill story because at least they have a deposit, but still risky because they got to get the mine built. The third thing are producers. Okay. Within the producers, you got big, medium, and small. Big are Barrick and Newmont. Very safe, lots of diversity, but very hard to grow production and very fully priced. So when the big money comes in, it'll initially go to those names, but it takes a lot of money to move those names. I mean, Barrick and Newmont have market caps of $46 billion, and it's going to take a lot of money to move the stocks up. Below them, you've got another whole class of miners, which I call emerging producers. These companies have found a deposit and built a mine and built a processing plant, and they are actually pulling ore out of the ground and generating positive cash flow. And so what you've got in these companies is three ways to make money. You can make money in the following ways. One, the price of gold goes up, so the margin goes up. Okay, that's item one. Two, they produce more ounces over time, and this is why I say emerging producers. You know, they may have one mine, they're building a second mine, they're increasing capacity at their first mine, so that maybe they're producing 100,000 ounces today, and in the future they're going to produce 200,000 ounces. So all other things being equal, they're going to double their cash flow. I mean, Barrick does 5 million ounces a year. They're struggling to maintain 5 million ounces a year. There's no way Barrick is going to produce 10 million ounces anytime in the next 5 or 10 years. There's just no way. It's physically impossible, okay? Yet I've got a lot of companies in the portfolio that are going to go from 100,000 ounces to 200,000 ounces. So they grow production. The third way they grow in value is their multiple expands, okay? So what you do is you look at what are you paying as a multiple of cash flow. So how do you find these companies? You go out and you look at all the gold mining companies and you start by screening for which ones are making positive cash flow. If they're not making positive cash flow, they don't qualify, okay? Then you look at, is that cash flow growing over time? And is it growing either based on higher price of gold or is it growing based on production growth? And so you can find how many ounces they're producing, how many they intend to produce in the future, and where they're going there. And so that's useful data. And, you know, no guarantees about future production, but over time you get who's got a reputation for doing what they say they're going to do, et cetera. Then what you can do is you can say, all right, let's look at this and say, all right, this company is producing this amount, and at $1,000 AISC and an $1,800 gold price, they're making $800 per ounce of production, and they're producing 100,000 ounces a year. Bingo. You know, at a mine level, they've got $80 million of cash flow. Now they've got sustaining CapEx to maybe grow the deposit. They've got SG&A and so forth below that. And they might have financing charges, whatever. But you can develop a kind of a free cash flow number coming out of that company. Then you can compare that to the market cap. And if you do this for Barrick or Newmont, you'll find that, you know, you're paying something like 10, 12, 15 times. And some of the really sexier ones like Kirkland Lake, you know, or Wesdome, you're up around 15 times cash flow. A lot of the ones I'm involved with, you're trading at kind of 4 to 5 times cash flow. So multiple expansion is when that small company gets bigger, better known, and people trust it more. And they're like, you know, this doesn't deserve a single mine discount, or this doesn't deserve the jurisdictional discount that it's got. Instead of trading at 4x cash flow, this thing should trade at 8x cash flow. And so all other things being equal, you've got to double in the stock just based on multiple expansion. So think about it. If you can get all three of these things lined up, the price of gold might go up, their production might go up, and their multiple might expand. Bingo. That's your sweet spot, right? You're looking for those three things. And that's what I do with my fund. That's why my fund doubled the GDXJ numbers last year, and I'm kind of doubling year to date so far. I've been doubling them this year. And I just, basically, that's what I do. I pick the companies that meet those three criteria, and I leave the other ones for the index guys to buy. But, you know, you can do this at home. You don't need me. It's a pretty simple formula. And it works really well right now because these juniors have been left for dead. I mean, we're coming out of it was a big bear market from 2011 to 2016. We got a bump up in 2016, but then we fell back down in 17 and 18. In 19, don't get me wrong, we started to go up. I mean, we're clearly, I was up 100% last year, and right now, year to date this year, I just did it this morning, I'm up about 70%. But, you know, the numbers, we still got a long ways to run. There's a chart in my report which shows that a lot of these gold bull markets, when they hit these stocks, you get 5, 6, 7x your money. And we've kind of done 1.5 to 2x if you kind of look at the index averages. So there's still room left. I mean, we're not at the end of it. I mean, I'd say we're in the third inning, maybe the second inning. It kind of depends on where the gold price goes. So people who are thinking about getting into it, I don't think you're too late. Having said that, having a 20 or 30% pull down in these stocks is like, you know, an everyday occurrence. So you might find one of these things I've just described, buy it right now when we actually are pretty overbought, frankly. Then suddenly you get a 30% drawdown, and it's like, holy shit, I screwed up. Well, no, you didn't. You might have not bought at the most opportune time. And so the way I think you address that, or I would recommend friends address this, and I was talking to my sister about this actually the other day, I said, you got a dollar cost average. You just got to say, all right, I want to put this amount into these things, and they're going to go up and down. And, I'm going to buy 4 equal amounts for the next 4 months. And, if we have a pull down, well, then I'll get a little more. And if it runs away from me, well, at least I made money on the first piece I bought. So they are volatile, and people should be aware of that. It's not easy. But I think assuming the gold price is going higher, which I strongly believe is true, and if you do the analysis and come to that conclusion, then I think you can rest comfortably that if you buy, even if you get that 30% drawdown, we are in a bull market for this stuff, and standard operating procedure in a bull market is you buy the dip. So, you leave yourself some dry powder, you buy some today, you get your drawdown, you buy the dip, and then when it comes back, you're glad you did, and your first piece comes back and even, and you made money on the dip that you bought. Excuse me, that's true. So that's kind of how I approach it, and that's what I would recommend people do. But everybody has to look at their own situation, and everybody has to recognize that these do have risk. And there have been times when the results in these things has been brutal. I mean, if you look at my results, which are published on my quarterly report, from 2011 to 2016, I stunk up the joint. I did terribly. I did better than the averages, but I did terribly. I lost a lot of money. It's timing on this kind of stuff on gold. 80% of the time, gold and gold stocks are not a good place to be investing. But in times when there are sovereign debt crises and times when there are credit bubble collapses, both of which I believe are going on right now, they happen to be extremely good places to be invested. And so, you've got to make your own decision on where are we in that cycle. And if you believe, as I do, that we're in a very opportune part of that cycle, then I think we're going to make some serious money here in the next few years. Obviously, you can only be comfortable doing it if you believe those things. So.
Excellent, Larry. That was a perfect explanation on what we should be looking for in a gold stock. One final question for you. Have you found any yellow hot dog relish yet?
No, I haven't. And, somebody said you're being awfully amateur putting that kind of stuff up there. It's not institutional quality stuff. But, I'm out there. I just react to what I see. I actually asked it as a sincere question. And what I learned, and I explained it, was that apparently some of these food manufacturers, because of COVID, have had to really cut back on SKUs. So they're like, well, look, we don't have as many people, whatever the issue is. And I guess yellow hot dog relish is not a popular SKU. And so it got cut out. And it's fascinating. If you go to Amazon, try and buy it. It's, they're price gouging on it because there's not much of it out there. It's the times we live in, right? The COVID thing is terribly sad. There are a lot of people hurting a lot more than this guy who doesn't have yellow hot dog relish. I just couldn't get it. I've been to 6 stores. I'm like, well, what is it? They got regular relish. They got a lot of other things, but for some reason, nobody's making yellow hot dog relish. I don't know why. But there you go. It's an SKU minimization scheme on the part of the major food manufacturers. So I feel sorry for the people who are suffering in this thing, and I'm certainly not one of them. So I'll do fine without my hot dog relish. And I hope we move through this thing quickly, and I hope the economy and the country heals. I hope people who are suffering stop suffering, because it's horrible what's happened. It's absolutely horrible. And I really feel for the whole country, and it's compounding the monetary problem. And I really wish we had better leadership, at all levels, because there is a solution to this monetary problem. And we don't have to go through a full-blown crisis here. We could restructure right now and get back on a good path. And people like Judy Shelton, I think, understand that. And so I hope the Congress does, or the Senate does approve her. But who knows if they'll have the intelligence to do that. I'm not holding my breath, but we will see. So all I would say to people is buy those coins. I don't think you'll regret it. They're money. They always have been. It's a great form of savings. And I think you might be surprised at how high the prices go. So.
Some sound advice there, Larry. Thanks very much for your time today.
Yeah, thanks, Tom, for having me on and for letting me hold forth. I hope I didn't spend too much time, but I hope it's helpful to somebody, and that's why I do it. So,
absolutely. I'm sure it will be.
I wish everybody good luck.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.
think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?